man. We are live on Facebook. We'll see how long this lasts. Howdy, everybody. All right, let me give you some fancy graphics here to show you what a crazy, awesome production this is from my house. Boom! There it is. NMLS 155010. Derrick Evans here. And I also have my homeboy, Jay Lee, is on the horn. What up, Jay?
Hey, what's up, guys?
I thought he was going to say, what's up, people?
What up?
So, man, we have some cool stuff today, man. Just from the standpoint of looking at, like, all right, what's the effect of what's going on right now? Jay, we've got some graphs to show people. We have some really interesting stuff that's taking place in the local marketplace. We also want to just kind of identify, like, hey, what has actually happened in the past? You know, when we've entered. First of all, are we entering a recession? A lot of people believe we are. And, you know, then from there, like, if we are entering a recession, what have recessions looked like for real estate? So we're going to go through that. We're going to give you updates on the data. How many people have coronavirus in San Diego? How many new cases are there? Live Well San Diego, by the way, which is run by Nick Mascione, a good buddy of mine. He is doing an incredible job over there and has been for years. He's publishing that data every single day on the Live Well page if you guys want to see it there. We'll go through mortgage rates, the Dow Jones, and we've got some interesting information coming out of the United Kingdom regarding coronavirus that I think everyone should know about. You know, it's hard to say who is an authority here, but what we can say is, you know, kind of what's going on, what's taking place, and just sort of take it from there. So we are live on Facebook. Unfortunately, the new software I'm using, I can't see live comments, which is a shame. But if you drop a comment in there, we'll get back to you after we're done with the broadcast. So let's just run through real quick here. Let's look at what rates did today, Jay. And I figured something out that I've been trying to figure out for a long time. The past, all week, it's Thursday, all week, we've had the Fed dropping $50 billion a day into the mortgage-backed securities market. And conforming loan rates haven't really improved. It's been super weird. So I finally figured out what's going on there. And what's happening is the servicing is basically getting killed because rates are so low. So the servicers who make some money, and by the way, banks like my bank, you know, my brand is Aligned Mortgage, but American Pacific Mortgage is our bank. They sell the servicing rights. So it's part of how they make money. Part of the way that they're able to keep rates low is they make money by selling servicing rights. Well, the servicers are seeing the servicing rights as worth nothing right now because they know everyone's refining out. They know that the Fed is in there buying bonds and that rates could go lower. And so they don't want to pay anything for these servicing rights. They're paying like pennies on the dollar now for servicing rights. So the banks have to bake that back in to the interest rates. And so they're not allowing them to come down where they should be. So that's what's going on. But if you check out this graph here, you'll see we're actually so high. Let me see if I can use my little command here. Nice. We're so high that look, Barry Habib, this comes from MBS Highway, by the way. It's where I get this data. Barry Habib is a genius, and he runs that organization. We're so high with the price, and the range is so big in such a short period of time that we've actually gotten interrupted by the drawing tools that are supposed to be up and way out of the way from where the action is taking place. But you can see here today we were down quite a bit at one point with these mortgage-backed securities, and we ended up the day up 48 basis points. So again, another good day for rates. Jay, I locked 2 VA loans today at 2.75. So
Nice.
yeah, brother. So it's still there, man. The action is there. The good stuff is there. It's hurting the servicers. It's hurting the conforming rates that the Fed is in here buying and making the rates so low. But it's also something that's creating opportunity, especially for people with VA loans, to save a bunch of money right here. So just wanted to make sure everyone knew what was going on there. Fed is still in there, still pulling the trigger, still holding rates at this level. It may be hurting the industry for a little bit. And in fact, Barry today said it would be great if they stopped buying bonds and rates would go up a little bit. Pricing would go up a little bit. Bonds went down. Pricing would actually get better, which is the opposite of how it's supposed to be. But he said that might be the case. And then one more thing, Jay, before we get to some of the stats and stuff we're going to talk about today is, so I nailed this yesterday. I don't know if you caught my video yesterday or not, but I said look out for the Dow today. So either today was going to be the worst, day that we've ever seen in the stock market, or they were going to run it up to 22,500. So in case you missed my video yesterday, that was what they're going to run it up to 22,500 and then kill it on Friday. And so that's exactly what happened today. They ran it up, and the Dow Jones closed at 22,552 today. Right at that number where I was explaining there's a huge piece of resistance, and the markets love to bounce off of this old support and move lower. And this is right where we closed today, right at that number. So you can also see, although it's harder to see on this graphic, that on our down days, the volume is much bigger than it is on our up days. And so that is also, just more signs that we're in a bear market situation, and we just need to be careful about stocks here. Today would not have been a bad day, in my opinion, to unload some stock if you had some that you were hanging on to. So who knows? We'll see what happens. But I think it's better today that we were up and sort of setting up for this normal, move back lower, as the trend is going to continue to be lower, in my opinion, than it would have been if we had got absolutely murdered today. So I'm happy with this particular outcome versus the potential alternative. But I do want to say that, it is happening. It's sort of playing out as expected, and that is a good thing. We had, I don't know, did you see the unemployment numbers today, Jay?
No, I haven't checked the unemployment. I've been looking more at what's, the market itself. Like you're talking about the bear market. What happens after a bear market? Hopefully we get a bull market, right? That'd be awesome.
I think so. Well, what happened today was, we were all waiting for this unemployment number to come out, and it was supposed to be, the worst one in history. They had anticipated that we were going to have 3.4 million unemployment claims, which would have been by far, even in the Great Depression, if you go back and you sort of, extrapolate these numbers, and even in 1982, which was the worst time, the Great Recession, the most we have is, I think, 630,000 unemployment claims for any one given quarter. In 1982 was the worst in history, with 695,000. We had 3.3 million today.
Yeah.
So dramatically, over 3 times as much as the highest ever. And somehow the stock market still went up 6-7%. So that tells us that Wall Street sort of expected this to be a lot worse than it was, or maybe they're buying into the potential vaccine stuff that's going on. There's rumors now of there being a different strain of coronavirus that's in Italy, something that could be the difference between some of the different numbers that you're seeing in different places. But that unemployment number today was horrible. For the stock market to be up is a little weird, but it feels like a setup to me, as I was describing last night. It feels like a setup. It feels like they're going to run it to that obvious resistance point and then kill it tomorrow. So we'll see what happens, but that's kind of how it's lining up. We do have some interesting information to share with you here. So I want to pop this up on the screen, Jay. This is COVID-19 cases in San Diego County. And this information comes from Live Well, San Diego, which is run through the county government. Okay, Nick Mascione runs this program, and it's an incredible program of health and wellness. He has thousands of employees that work for Live Well that he manages. So here's the data. So we have, as of the 24th, we had 49 new cases that day, and we have a total of 297 in San Diego County that we are aware of. So 297 total cases of coronavirus in San Diego County. There very well may be more than that, but those are the ones we know about as of right now. I don't know how many people have been tested. That's what I would like to know. But we do know that there's some interesting stuff that's taking place there, and that this whole situation could potentially lead us to, and the topic of this video is, is this going to lead us into a recession? A lot of people believe it has to. The numbers are just so big, and the unemployment numbers sort of point us in that direction. So the question is, and this is one of the reasons I want to have Jay on today, does a recession, is that going to be something that hurts real estate historically? And Jay, you've got some thoughts on that.
Yeah, man. Appreciate you bringing that part up. So, everybody looks back to the last recession, right? 2008. No one looks further back. So if we go a little bit further back, and I sent you the graphic on it, if you could pull that up for everybody. Historically speaking, the last 5 recessions have not created a housing crisis, such as, the huge drop of purchase price on homes. So when you look at like last recession, right, we had a huge drop in it. It drops, what was it, 19.7% overall in 2008. But if you go back to 2001, during the recession then, we actually had a 6.6% increase in property value. And then 1991, we had a 1.9% decrease. Not very big.
Yeah.
Go back to 81, we had a 3.5% increase. In 1980, we had a 6.1% increase. So back in the early 80s, in that huge recession where we had interest rates, in the teens, 15%, 17%, 18%, properties were still going up in price. If we look at what's going on right now in the San Diego market, we had less homes, about 8,000 homes were built in the county last year, about 1,500 short of what was built the year before. The biggest problem that we have right now is available housing. There is not enough houses in San Diego County to continue with the growth of our county. There's so many people moving here, not just military folks, but just people that, everyone that I talk to that's a transplant always ends up saying it's either San Diego or it was Hawaii. Well, I chose to go to San Diego because I can go to Vegas, LA, Mexico, everything else, right? So a lot of people are choosing us over Hawaii just because they can go to so many more places if they just want to get a quick getaway. Hawaii, you're, a 5-hour flight from wherever you want to go. Amazing place, but still, nothing's like San Diego. So if you look at our housing market by 2050, we're going to be over 250,000 homes short of what we need in that point in time. So, people are like, oh, that's 2050. It's 2020. That's only 30 years away. Yeah. 250,000 homes need to be built just to keep up with the growth, and that's not happening.
It's not even close to happening.
No.
It's decreasing, actually, the number of homes that are being built every year, and there's a lot of reasons why, regulations being one of them. And to just speak back to this graphic here, we see that really, those last 4 recessions, if you look at 80, 81, 91, 2001, what right. those numbers look like, just kind of normal real estate numbers. You're up, you have a nice year, then you have a normal year, then you have one little slightly down year, and then you have another nice year. 2008, and what I see here as kind of a mortgage guy and just sort of an interest rate nerd, is what you notice is it's all based on interest rates. And this is why I've been so adamant that the Federal Reserve does what they've done, which is to keep interest rates low. The consequences of them keeping them so low so quickly, maybe I missed where the damage could be done, but I still think it's better than the alternative. I would like to see them overreact versus underreact in that situation. But if you look at those right. numbers again, you'll see it's basically interest rates. When interest rates have gone down, housing values have gone up. And when interest rates went up, like they did in 2008, which was kind of a knee-jerk, it was the thing that the Fed was preventing this time was what happened back then. And so fortunately, right. That's not happening this time, because if interest rates spike, you are going to see property values decrease. There's a whole bunch of things that built into that 2008 situation where really mortgages and real estate unfortunately caused the recession itself. So that was a bummer. That hurt things. And if that hadn't been the case, then who knows what that recession would have looked like. There are a lot of different things that could have caused it. But because it was mortgages right. specifically, because it was real estate specifically, that spooked people a little bit. We also had lower rents at that time. And it just made a lot of sense for people to exit, their real estate holdings, which, this time we're not seeing that situation exist this time. So I want to point out that a lot of this is interest rate driven. And if we continue to have, lower interest rates, then I don't think we'll see an issue. Now, let me ask you, Jay, because I'm curious what your feeling is. I know what I'm seeing is a lot of people are, the big problem that we have right now in real estate isn't that there aren't buyers or that people are spooked or whatever. It's that agents are being told not to show homes to people, and people are desperately trying to look at and buy homes.
Yeah, so we've been directed by CAR, California Association of Realtors, to do no in-person meetings with clients. One of the ways that my team and I have gotten around that is by for them. They can, stay home or drive to the property, check it out from the outside, and sit in their car. And, we can go through the property for them, FaceTime them, Zoom call, whatever kind of phone or application that you have to view a home, and we can show it to them with them right outside, and never come within 6 feet of them or 10 feet of them. Um, we are not. It's not stopping us from doing business. A lot of people have gotten scared of doing it, and it's not even about the people wanting to buy or not wanting to buy, or wanting to sell or not wanting to sell. It's legitimately just been the guidance from CAR saying, hey, don't meet with anybody in person, and everyone's trying to find a way around that. So we found a way around that. We even found a way to do virtual open houses, which you will have to see next week on one of our videos, because it's pretty impressive what we have set up coming up here next week. But no, like, the market's still moving. We opened, what was it, 4 or 5 escrows over this past weekend, and nothing's stopping the business. Like, homes are still selling. The only thing that's becoming an issue is the legal ramifications of meeting with your clients in person, because then you can be held liable for if they catch the virus, and if they were to get ill and die or anything like that. I mean, that's an extreme case, right?
Yeah.
As long as you take your precautions and don't come within 6 feet, don't be within that area of them at the same time, you should be fine. So we're still finding ways to navigate today's climate with the coronavirus, and keep moving forward, and helping our clients become homeowners, and helping our clients sell their homes for the most amount of money.
Yeah, I think it's interesting because I'm very bullish right now, which is weird. I'm typically a bear, and I'm definitely bearish on stocks, but real estate, as you mentioned, as we showed with the graphic, and I'll just put it back up there. Recession does not equal housing crisis. I mean, it did last time, but that was actually a rare situation if you look at the last 5 recessions. So this is from Keeping Current Matters. By the way, we'll give Steve Harvey a little credit, or not Steve Harvey, Steve Harney, right? A little credit for providing this information. But for me, I'm very bullish, because this is the opportunity that buyers have been waiting for. I mean, how many buyers have been sitting around going, well, I'll wait until there's some blood in the streets. So I'll wait until the sellers don't have such an upper hand. I'll wait until there's an opportunity. This is the one. This is what it looks like. It may not be pretty, but it's not going to be pretty if you have a good buying opportunity. And honestly, it's really not ugly. In fact, I lost one. I might lose another one this week in a multiple offer situation. So that somehow people are still figuring out how to find houses, how to get interested in buying them. They're still getting financing. Agents are still writing offers. So for that to be taking place based upon the things